Everybody, it's Dr. Joe's in the house, and hope you're doing well wherever you are. And another Wealth Wednesday is scheduled, and it is live. So hope you had a wonderful week so far. And we are the temperature's getting hot over here, so this is good. I like warm weather, hot weather, and so on. So today we're going to talk about multifamily. You know me, I'm really into single families, but a lot of people have talked about, asked me about why, Dr. Joe, aren't you doing multifamily? Why should I consider multifamily? And so I thought I'll have a session about that. So today we're going to focus on multifamily wealth building with multifamily properties, and kind of talk about some of the success strategies that you may want to consider using. That quite a few. Oops, sorry about that other investors have been using, as they invest in multifamily. So it's going to be a good session. Again, you can see the ticker underneath. We're going to have an event next Saturday, not this Saturday. It was originally scheduled for the 15th, but we had a schedule conflict with Corliss and Fitz. And so we had to change it to June the 22nd, which is not this Saturday, but the week on Saturday here in Washington, D.C. It's going to be Corliss and Fitz, they're students. This is their first house, and here in Washington, D.C. And they're going to be doing the BRRRR strategy, implementing my strategy. They bought a house, 3 bedrooms, 1 bath, and they turned it into a 6 bedrooms, 3.5 bath. And so where we are right now is that we are kind of midway through the rehab. So we're at what we call the roughing stage. So we've done all the framing. Well, first of all, we hired an architect to come up with the design, and then we've done the framing of that per the design. And then the HVAC people came in and ran all the ducts. And then the plumbers came and they dug the floor in the basement and run new pipes throughout the entire house. The electricians are there right now, and they're running the electrical wires. And so hopefully, probably Monday, we'll do the roughing inspection. So we'll have the inspector go over there. And after that, then we'll do the installation inspection. And then hopefully, if everything's okay, we'll then be allowed to what we call close up, which is put the drywall up. So we're going to do the event before we put the drywall. So everyone will get a chance to see what's behind the walls, what's behind the drywall, which most people never get the opportunity to do. So that's what we're going to do on the 22nd. So please join us if you're in the Washington, D.C. area. If you're not in the Washington, D.C. area, I would strongly ask if you're going to be around to come on, join us. I think you'll enjoy it. Great opportunity to learn and also to network with like-minded people. So you go to my website, www.joeasimo.com, www.joeasimo.com, and where you can register. And all the sessions so far have been great, and really excited. Looking forward to this one, June the 22nd. And then we'll probably do another one once they finish the house. And so you'll see the end result. And also shout out to Charles. We started his project last week, the renovations, making good progress. I was over there earlier this week, very impressed. And that's also going to turn that into a 6-bedroom house as well. So if you want to know how you do that, how you take 3-bedroom houses and turn into 6, you may want to come along to the event on the 22nd. So again, register and sign up at my website, joeasimo.com, www.joeasimo.com. So again, today's session, we're going to talk about wealth building with multifamily properties. And so I'm looking forward to this one. So let's, as I say, get the show on the road. So the question becomes, let's have a look. Why is understanding multifamily properties crucial for building long-term wealth in real estate? So why is multifamily, why do people use or buy and invest in multifamily? And, what does it do for them? You know me, I'm a single family guy, but I have nothing against multifamily. It's just I do single family because I know what I understand that market. It's worked for me. And likewise, there's people who do multifamily who can't believe I do single family. So, the grass is always green on the other side. And there are, as in real estate, there's hundreds and thousands of ways to build wealth. And so multifamily is definitely a time-tested strategy. And so I think it's worthy of me to explore. Like, even though I don't do it, I think it's worthy for me to share with you some of the benefits and why you should even consider it yourself. Okay. So why is understanding multifamily properties crucial for building wealth? Multifamily properties represents really a cornerstone for wealth building for a lot of people. It has some inherent advantages, over single family houses. And they generate consistent rental income, but also they have the benefits of what we call economies of scale. You can scale up with multifamily a lot more so than single family. Single family, obviously, you've got one house. Multifamily, you can buy a 5-unit, 10-unit, 15-unit, 4-unit in one place. So you can get a large number of units very, very quickly. And so because you got the economies of scale, the cost per unit is relatively lower, and as you buy more units, the cost per unit goes down. Hope that makes sense. So this is really appealing for investors who want to maximize their ROI, return on investment, while minimizing the operational cost. You've just got one building which has multiple units as opposed to multiple buildings in multiple locations. So you can minimize operational costs. You got everything centered in one place. Okay, so the ability to really spread risk across multiple units, is an attractive feature. And if you have vacancies, you can spread those vacancies over a number of properties. As you know, in single families, if you've got a vacancy, you have nothing coming in. Whereas in multifamily, if you have a vacancy, you still got income from the other units, which is still occupied, hopefully. And so you have a more stable potential income stream compared to single families. Another critical advantage of multifamily is the opportunity to grow, equity growth, anyway, that is. Because one thing about multifamily is that many times the value is based on the cash flow that's generated, and so you can do things to add value to the house, and you're not beholden to comps, what other people are doing, as you are in single family. So there's things you can do to increase the value. Obviously, you can improve the property. You can improve the property management skills. So you have better management, I suppose. And if you have more customer satisfaction, then people will stay longer, and therefore your income is a lot more reliable, and therefore the value is also grow on. So so you can have what we call a value add strategy, which not only boosts the rental income, but also can significantly increase the market value of the asset, which in turn will lead to higher returns on investments when you decide to sell or refinance the property. So these are some of the things that you can get with multifamily that you may not always be possible with single family, and so on. So in addition to multifamily and to the benefits that we just talked about, it's real estate, so you have some other benefits, like there are tax benefits, like depreciation, mortgage interest deductions. You can write off a lot of your expenses as well. So there are lots of tax benefits associated with multifamily, and if you're savvy, you can optimize those. So that's kind of a little overview. So let's get down to a bit more detail on each one of those areas. So number one is why. Why should you invest or consider investing in multifamily properties? And the question I suppose you want to ask yourself is, what makes multifamily properties a compelling investment for building long-term wealth? So what's so attractive about multifamily compared to single families? Well, in the real world, multifamily properties stand out as really as attractive investment options for several reasons, really. Firstly, it's a reliable income stream. Unlike single family, multifamilies have, you have multiple rentals in one building, which means that if you have a vacancy, you still get an income from the other units, which you don't have in single family. So even if 1 or 2 units are vacant and you have, let's say, a 10-unit building, you still get an income from the other 9 or 8. Okay, so it's more reliable, steady cash flow that's coming in. And also, as I mentioned before in the introduction, you have the benefits of economies of scale when you do multifamily, because you have multiple units in one building. And so it's more cost effective than managing, let's say you have a 10-unit building. It's easier to manage 10 units in one building than have 10 single family houses spread across multiple locations. So it's just easier, and so on. So you have shared walls, you got shared roofs, you got shared systems, and which means that you have lower maintenance and repair costs because per unit, that is anyway. Additionally, property management fees tends to be lower in multi-families compared to single families. Again, you got economies of scale, and this efficiency in management, makes that you can sort of maximize your returns in terms of management anyway in multi-family compared to single family. It's just easier to have everything done in one location as opposed to having 10 different locations spread across different parts of town and things like that. So multi-family properties, they really do have the potential for appreciation, okay, because the value, is, it's sort of driven by the income that the asset generates. Okay, so therefore, there's things that you can do to increase the income. Okay, you can do strategic improvements to the property and therefore increase the rents. You can have better management, so you can have better quality management, which can increase the decrease the turnovers. There's lots of things you can do if you have good solid management. And if you have good solid management, then you have turnover costs are lower, your cash flow is higher, and therefore the value of the asset goes up. And so on. So these are some of the things that you can do. You can add value, which also not just increases the income, but also significantly can increase the market value of the asset. So therefore, if the value goes up, then your equity will also go up in the value in the property when you either refinance or sell at a later date. As I said before, there are it is real estate, so you have tax benefits associated with owning multifamily buildings, like depreciation, interest deductions, and operational expenses and things like that. Okay, so let's talk about some of the action items that you can consider doing as it pertains to why invest in multifamily properties. A couple of action items. One is research. If you're interested in multifamily, then you may want to research your local market wherever you are. So you want to conduct thorough market research to understand the rental demand, vacancy rates, and economic factors in your target area, wherever you're interested in, because this will help you identify sort of the more promising locations where to invest. Another thing you may want to do is to evaluate the cash flow potential of your property that you're thinking of. So there are financial models that you can use to project rental income, operating expenses, potential returns, etc. And so you may want to check into that. And also, you can obviously, it's financing. You got to know where you're going to get the money from. So there are various financing options, including traditional banks, government-backed loans, private financing. And when you're doing that, obviously you want to compare things like interest rates, terms, eligibility requirements, so you can get the best financing. Okay, so that's number one. Let's go to number two, which is identifying high potential properties. So now we've answered the question why we should do it. The next thing is we got to figure out, okay, where do we buy? What do we buy? And how do we identify the potential opportunities? So the question is going to be, how do successful investors identify and acquire high potential multifamily properties? How do successful investors, how do they identify them and how do they buy them? Okay, so identifying high potential multi properties is a skill like anything. Single family, identifying quality single families is a skill. It's a critical skill that you need to master in order to maximize your returns. Okay, so successful investors typically begin by conducting a comprehensive analysis of the neighborhood where they're thinking of investing, and also the local market trends. Real estate is all local, so you want to know what's going on in your local area, what the trends are. Are people moving in, moving out? Are business coming in and coming out? What are the key things to consider? Things like employment rates. Is employment going down or going up? Is the population growth? Are people moving in or moving out? And what are the amenities that's close to the place that you're investing? Because obviously, if you've got renters, they're going to be interested in things like schools, shopping, recreation, transportation, and things like that. So where, how do those amenities, how far are those amenities? How close are those amenities to where you're looking at thinking of investing? Also, the job growth, as I talked before, people follow jobs. So if there's an influx of employment, then people are going to come. When people come, they're probably going to need somewhere to stay, and so therefore it's going to increase your occupancy rates, which in turn will increase your potential cash flow. And so once you've identified a promising area, then the next thing you got to do is to look at the financial performance of that. And so there are different what we call financial metrics that you may want to consider, and there's several in the multifamily space. There's certain things. Hopefully, you've heard these terms before: cap rate or capitalization rate. There's another term called cash-on-cash returns. Another one called internal rate of return. I mean, there's so many different terms: IRR, NOI, net operating income, NPV, net present value. There's a whole bunch of different, sort of metrics that you can use when deciding whether to buy or not buy. So let's talk about the cap rate. The cap rate is a ratio of the property's net operating income, that's the gross rent coming in, to its purchase price, to how much you pay for it. And so this is the ratio, and it helps investors determine the potential return on investment. So the properties with the higher cap rates, when you do that calculation, are often more attractive as they indicate better income relative to the purchase price. Okay. Another metric is what we call cash-on-cash return. Again, I don't want to get too much into the weeds. It can get a little dry, but I'll just quickly go through these things. Cash on cash is the annual return on the actual cash that you've invested on this, on this house or its multifamily building, because it provides a clearer picture of the property's profitability. IRR, internal rate of return, that's another metric. Takes into account the time value of money. So money today is worth more than money in 5 years from now. A dollar today is worth more than a dollar 10, 5, 15 years from now. So the internal rate of return, IRR, takes that into account, the time value of money, and it allows you to do a real comprehensive view of the overall performance of your money. In addition to financial metrics, successful investors look at other metrics. Things like the value add potential, which is what can you do strategically to improve the value of the house. Maybe you do things that will will allow you to increase the rents, add more bedrooms, add more bathrooms, renovate make the place nicer, do some landscaping, repaint the house, add better, appliances, and so on. So you can do strategic improvements that will allow you to raise the rents. Also, better management practices. Sometimes, apartment buildings, they just can't manage that well. And so if you can come in there and take control and manage more effectively and efficiently, you may be able to increase your income flow. You can reduce your turnover cost, which in turn will increase the value of the asset. And other things you can do is, I think that's enough. So, so essentially, there are value add plays that you can make on a multifamily to increase the value and of what the asset's worth, which you can't always do in single families, because single family is all heavily skewed based on what we call comps, what other houses are in the area. So you can do all these bells and whistles, but if the houses in that area, are going down, then yours is going to go down as well. So, so you have more control in the multifamily space to force appreciation, to force value, than you do in single families. Also, in terms of what identifying properties is due diligence. Okay, so due diligence is another crucial step, I think, in identifying high potential properties. So, due diligence is sort of doing the investigations to uncover lots of different things, whether it be, uncover damages to the house, underlying structural issues or mechanical issues or operational issues that may not be immediately visible. So obviously you want to have inspectors, check the property structure, electrical systems, plumbing systems, HVAC systems, and so on. Additionally, you can do some due diligence on the financial records of the owner, current owner. Why are they selling? Are they cooking the books? You want to look at those books to make sure that what they're saying they're getting is in fact what they actually getting, and the expenses that they're saying it costs is in fact what it really costs. So you can do some due diligence on the books. You can review things like income statements, rent rolls, and expense reports to ensure that the financial health of the asset is in fact sound. So thorough diligence, due diligence, I think is really, really important if you're going to go to multifamily space to avoid potential pitfalls. And so it allows you to make what we call informed decisions. So some of the action items you may want to consider in terms of the identifying high potential properties: perform market analysis, use different tools like Zillow, CoStar, MLS to gather data, things like employment data, population growth, rental demand, etc. Analyze financial metrics, calculate cap rates, cash on cash returns, and IRR for each property to assess their financial performance and the potential returns. Also assess value add opportunities, identify properties that offer potential for value enhancements through renovations, improved management, or even operational efficiencies. So that's number 2. Again, we're going to go down to the Ask Dr. Joe segment in about 10 minutes. So if you've got some questions, please put them in the chat box, and I definitely get to them about 10 minutes probably from now. And also, if shout out on June the 22nd, you can see the ticker. We're going to have an event at one of my students' house, Corliss and Fitz in Washington, D.C. It's going to be great. I mean, they're going through a BRRRR project. And so if you want to see how a BRRRR project is actually implemented and executed, they're in the renovation phase. This is the event you may want to come to. Not so much you should come to. June the 22nd between 11 and 1. Please sign up. You can go sign up at my website, www.joeasamoah.com. That's www.joeasamoah.com. And you'll see in real time what it takes to actually implement a BRRRR using the my strategy, which is the Section 8. That's what we're trying to do here. We're turning a 3-bedroom, 1-bath house and turning it into a 6-bedroom, 4-bath. And I think after all is said and done, it's going to be about $6,200 in terms of the rent, which will allow them to get a little bit of cash flow, which is very difficult in places like here in Washington, D.C., where it's very expensive to buy houses. So you'll learn about all that. Plus also you'll be able to network with like-minded people. And also you can spend some time with me, and hopefully I'll get a chance to meet you, and we can sort of communicate and share ideas and things like that. So sign up at my website, joeasamoah.com, and register for the event. Okay, number 3, optimizing property management. Property management, obviously, the question I suppose you want to ask is what strategies can optimize property management to maximize profitability. So what can you do to manage the property so you can maximize profitability? Well, optimizing, I suppose, property management is really crucial. At the end of the day, it's easy to get people in your property. It's a lot more difficult to get them out. It's management is the key. You can have all these cash flow IRR projections. If the tenants aren't paying you rent, if they're trashing your property, if they're causing mayhem, then it's going to obviously affect your profitability if you're going to make any. Okay, so optimizing property management is real crucial. We're now talking about operations now. It's crucial to maximize your profitability and ensuring long-term success of your multifamily investment. So effective property management, in my opinion, begins with implementation of robust management systems. So utilizing property management software, there's software out there that can help you in that process. There's a number of them. Appfolio, Buildium, Yardi, plus 1,000 other ones. They can help you streamline your operations. These platforms offer several things. Features like for tracking rental payments, handling maintenance requests, managing tenant communications, plus a lot more. Doing the financing, automating these processes reduces administrative burden. It minimizes errors and ensures that tasks are completed efficiently and on time. Another key aspect of optimizing property management is maintaining high property standards and focus on tenant retention, keeping tenants so they stay longer. Happy tenants obviously are more likely to pay their rent, renew their leases, and stay longer, which in turn will reduce your vacancy rates and your turnover costs, which can be very, very high. Investors should prioritize, in my opinion, property maintenance and timely response to maintenance issues or requests. Nothing worse than for a tenant is you got something going on in your property and the management is just ignoring you, not doing anything about it. So effective communication with tenants is really vital in optimizing the property management. So establishing clear channels of communications, being responsive to tenant concerns, it really fosters a more positive landlord-tenant relationship. You can do things like surveying the tenants, gauging from them how you're doing, get feedback from them, any improvements, and just valuing your customers, valuing your tenants, hiring professional property management if necessary. If you don't have the time to do it, it can be a wise investment. Professional management obviously brings expertise and experience in managing multifamily properties. Really ensuring that your operations is run smoothly and efficiently. They can handle things like tenant screening, lease management, to maintenance and financial reporting. There is a cost, obviously, with property management, but property management fees for multifamily tends to be a little cheaper on a percentage basis than it is for single families, because you have the economies of scale associated with multifamily. Action items as it pertains to optimizing property management. Invest in property management software. As I said before, there's lots of different platforms out there. There's Appfolio, Buildium, Yardi, and so forth that can help you streamline your operations, track payments, streamline operations, and handle maintenance requests and things like that. Enhance what I call tenant retention strategies. Maintain high standards. Respond promptly to maintenance requests. And consider sort of upgrading amenities to improve tenant satisfaction is something you may want to consider as well. And if you're not up for it, then you may want to consider professional property management as well, because it can be a good ROI on that as well. So let's go to number 4, learning from successful investors. That's another thing you may want to do. Is, as I said, the saying goes, the wise man learns from his mistakes, a genius learns from other people's mistakes. You want to network, you want to learn from others, so that way you don't repeat or make what I call unnecessary mistakes. So what lessons can be learned from investors who have successfully navigated the multifamily market? So that's what you want to do. You want to learn from other people, successful people, not just anybody, but people who are successfully doing this. And there are successful people everywhere. Wherever your market is, there's successful people who are who are doing fantastic. So successful multifamily investors often highlight the importance of just like in anything in real estate. It's really important to persistence and resilience. Things don't always go right. Things go wrong sometimes, but you got to stay with it. You got, as the saying goes, roll with the punches. When the going gets tough, the tough get going. Real estate investing is, especially multifamily space, there's a lot of challenges, and there's market fluctuations, and there's unexpected maintenance issues. You get hit with curveballs all the time, and so successful investors, I think, understand that setbacks are just part of the process. The issue is, what do you learn from that? And so hopefully you can avoid making those same mistakes in the future again. So adaptability is crucial. It's a crucial trait for successful investors: the ability to adapt, the ability to modify, the ability to sort of reposition based on the realities of what's going on. So the real estate market, as we all know, is dynamic. It's influenced by various economic, social, and political factors. And so investors, obviously, who thrive well, they stay informed about market trends. They're flexible and able to adjust their strategies accordingly due to changes. They regularly review and analyze market data, attend industry seminars, and engage with other professionals to kind of stay ahead of the curve. And this proactive approach allows you to capitalize on emerging opportunities and also mitigate potential risk before they make those mistakes. The learning from mistakes from others is fundamental principle for any investor. Every investment, whether successful or not, there's valuable insights that you can learn. And I think that investors who take the time to analyze past deals, understand what went right and what went wrong, and apply these lessons to future investments are likely to be successful in the long term. Because there's no point, making mistakes and just repeating mistakes all the time. You need to step back every now and then and figure out exactly what went right, what went wrong. If I had to do the same thing again, what would I do differently? And so this reflective practice helps you to refine decision making and also improve things like due diligence and develop effective management strategies. So by learning from mistakes, really, you avoid repeating them. I mean, that's obvious. And you have a better, deeper understanding of the intricacies of multifamily investing. So, network, build relationships with others. That's all important. Share ideas, learn from others, and discuss with others the challenge that they faced, and brainstorm solutions and gain encouragement. So, in terms of action items associated with learning from successful investors, analyze your past deals, stay informed, and be adaptable, and network with other investors. So with that said and done, it's now going to 7:34. Let's go wrap this up with a conclusion. The conclusion is, how can investors apply strategies discussed in today's live stream to build a successful multifamily real estate portfolio? Building a successful multifamily portfolio requires really a blend of what I consider strategic insights, practical management skills, and a commitment to ongoing education. You never learn. You should never stop learning. I'm learning. I'm always trying to expand my horizons and my my education. So so really applying some of the strategies discussed in today's live stream, investors can position themselves, I think, to achieve long-term financial success. Multifamily buildings, they offer unique opportunities, steady cash flow, economies of scale, and significant appreciation, especially if you do the value add strategy. Understanding and leveraging these advantages is the first step towards a robust investment portfolio. And one of the key takeaways, I think, is the importance of market research and due diligence. So stay informed about market trends, analyze financial metrics, and conduct detailed property inspections to identify high potential properties. And this proactive approach really is designed to minimize risk and to maximize your returns. Okay, so I think that's probably enough for today. And hopefully this is helpful. I say I don't normally talk about multifamily very often, but I think that it's appropriate for me to talk about the pros. And although I don't do it, I think it's something that you may want to consider doing. So that's then. Get your questions ready and put them in the chat box, and I will get to them in a couple of minutes. Again, if you want to shoot me an email, you can always email me at joe@joeasimo.com, joe@joeasimo.com. And if you want to book a one-on-one with me, if you want to, if you got some issues, problems, challenges that you're facing, and you want me to help you, and we do a deep dive into whatever the issue is, then please feel free to go to my website and book a one-on-one with me. There is a fee to that one. It's reasonable. But every one that I've done quite a few of these. It's always been successful. It's always been, insightful for the customer, the student, the client, and so on. So feel free to book a one-on-one with me. And again, we will be having an event next Saturday, not this Saturday, but June the 22nd, local event here in Washington, D.C., where we're going behind the scenes of a real-time BRRRR project with Corliss and Fritz, their property in Northwest Washington, D.C., and they bought a 3-bedroom, 1-bath house, and they're turning it into a 6-bedroom, 3.5-bath house. 6-bedroom, amazing. So if you want to learn how they do that, tips and tricks. And if you want to see the good, the bad, the ugly, what goes right, what goes wrong, the importance of having a system in place, having the team in place, having good contractors, how to select contractors, how to manage contractors, all that stuff, how to get the money. We're going to be there next Saturday, so please sign up, register, and hopefully I'll see you. So you can sign up at my website, joeasimo.com, for next Saturday's event. So with that said and done, my friends, let's go down to comments, and let's see what we have today. So, financial firefighter, hey, aloha from Hawaii. Hope you're doing well. You need to tell me what your name is. You just say you're financial firefighter. You're a regular, so thank you for tuning in every week. But aloha anyway. I haven't been to Hawaii for a long time. So maybe one day I'll go there. I'm going to East Africa in August. I'm going to Tanzania, Uganda, and maybe go to Kenya. We're going to Zanzibar. We're going to see the the migration of the animal migration safari. So yeah, that's in August. I'll keep you updated about that one. Melissa, the appraiser from Denver. Hey, Melissa. Hope you're doing well. Hope your appraisal business is going well. And thanks for checking in with me, Melissa. From within she Queens. From within she Queens. Oh my God, whatever that means. Hello, Dr. Joe. Thanks for your time. What's your thoughts on seller financing for a 2-bath under 69,000? Comps in the area are 135,000. Okay. So from within, you didn't tell me what area you're in. From within she Queens. I don't know if this is, well, it's not Queens in New York, I tell you that, because you're not going to buy anything for 69,000 in New York. But anyway, so you're looking to buy a property where the seller is going to be providing the financing. It's a 3-bedroom, 2-bath house or apartment. I'm not too sure. For $69K, and comps in the areas are 135. So there's definitely equity there. That's a good $60,000, $70,000 worth of equity from day one. Well, it depends what the repairs are. What do you need to do to this property to get to a value of 135? How much do you have to spend? That's what's going to be, do you have to spend 5,000, 10,000, 20,000, 100,000 in order to make it to 135? So it means what's the condition of the property, and what do you have to do to transform it from its current situation to its final situation? But if that number, the renovation cost and the holding cost is reasonable, then it may be a good deal, especially if the seller is prepared to finance the acquisition. Now, you don't say if the seller is prepared to finance the renovations, if there are any renovations. So you're going to have to fund that, and hopefully you have that money. But on face value, if the seller is going to fund it and you have access to your own financing to to do the renovations such that you can get to the value of 135. And if that number is in fact reasonable, and the market wherever you are is, people want to live there, people want to buy there, then it could be a fair deal from within She Queens. So if you give me more details, I'll be more than happy to, dig further. We can't hear you. Okay. So you can't hear. Well, hopefully you can hear me. Yeah, hopefully you can hear me. I think you say you're okay now. So I think yeah, okay, good now. Okay, good. Well, I'm glad. Otherwise, I'll be talking to myself. From within She Queens, when are you coming out to California? Okay, so you're in California. 69,000 in California. My goodness, that sounds pretty good. When am I coming to California? I've been, when's the last time? I was in California. I was a speaker at Bigger Pockets a couple of years back. That was in San Diego. I love California. So maybe one day I'll, in the near future, get the opportunity to come over there and, let me know where you are. And maybe if there's enough people in California, maybe, we'll do something in California for you guys and so on. Okay, so Jennifer is okay, good now, good. Yes, I would like to know what value I can contribute to learn from an investor. What value can I can contribute? Well, what I need to know, Jennifer, is more about you in terms of what your skill sets are, what you're trying to do in terms of your goals, real estate goals, and whether we can work together. That may be worthwhile to book a one-on-one with me because I don't think we can go into too much detail on this session here. But if you're serious about wanting to learn from me, I'm not too sure where you are. You can, by all means, you can attend the next event we're doing on the 22nd, if that's realistic. Otherwise, book a one-on-one with me, and then we can sort of deep dive and see how I can be of assistance to you, and see if you can be of assistance to what I'm doing. I'm always trying to network with other people. If I can help you, and if you can bring some value to what I'm doing, hey, we can talk and we can brainstorm and see where we can go. So Jennifer, if that makes sense, let's connect and see what we can do. But I would suggest, if it's okay with you, let's book a one-on-one so we can really do a deep dive. I can better understanding what it is that you're trying to do and so on. Jennifer again. Oh, great. I will book an appointment with you. Okay, thank you. Yeah, so book it up and let's see what we can do. Okay. Melissa, just an update. I was here a few weeks ago telling you about selling my condo in Denver. Okay. I remember now. In order to buy small multifamily in Cleveland. Yes, I remember, Melissa. I sold to my tenants. I walked away. Oh, 145K. Okay. All right. Good for you. Okay. So congratulations, Melissa, on selling your property, your condo in Denver, netting 145K. It sounds like you want to buy a small multifamily in Cleveland, Ohio. I'm not too sure if you've done a 1031 exchange. That way you could avoid some of the, or let's not avoid, but defer, some of the gain. Otherwise, buy the small if it makes sense, buy the multifamily in Cleveland. Obviously, you're going to need management. You're going to need to have a team over there, people who can look out for your interest. But yeah, I mean, congratulations, Melissa, and let me know if I can be of further assistance to you. Marathon Trucking, hit the like button. It's free. Do you think 500 cash flow? Hit the like button. It's free. This is from Marathon Trucking. You're gonna have to provide some context. I'm not sure if I understand this, Marathon. Hit the like button. It's free. Do you think 500 cash flow? It depends. 500 cash flow. If it depends on how much you're acquiring the property for. If you can get $500 cash flow every month reliably, that's not bad. A few of those, I think, will add up. So yeah, without unless you provide more details, Marathon Trucking, I'm really not too sure if I can provide additional feedback beyond $500 a month. Cash flow sounds reasonable, but it depends on the price. If you're paying 100 million, no. If you're paying 50,000, maybe, yeah, definitely. So it just depends on the acquisition, renovation prices, and things like that. From within She Queens, I'm looking into Georgia. Okay, so Georgia, you can buy prices for 69K. It sounds like it depends obviously which part of Georgia, but yeah, I think if you can buy a property and the seller can fund the acquisition and it doesn't need a lot of work. Depends what your exit strategy is, if you're going to flip it or whether you're going to hold it. It may make sense. So if you want to provide more information, I can definitely try to see if I can go a little deeper for you. Melissa, I have found my agent that is also an investor. I assume that's in Cleveland. Now I just need a good lender that does not require a minimum of $100,000 loan. Okay, you're gonna have to find a lender that will fund your acquisition in where you're buying. I think Cleveland, I think it is, and 69K. So yeah, some lenders, because they go through a lot of work to do a loan, they say it's not worth it unless there's a minimum price for the loan value. So yeah, you're gonna have to shop around. I don't think I can help you because in this area you can't buy anything for 100K. So I never have that issue. But you may want to check out Bigger Pockets and throw it out there. There's probably people all around who operate in Ohio, who got lenders over there who service Ohio, who can probably give you an idea of who can borrow you money, for the acquisition of 65, 70,000, loan. I'm a beginner, so not sure yet. Okay. Well, if you're a beginner, then you're going to have to do some due diligence, to make sure that it is a good deal. So I would say if you're buying it for 60, I forgot the numbers now, 65K, I think you said, and the seller is providing financing for you, and it's worth 135 fixed up. I think the issue is going to be what's it going to take to get it to that $135,000 state. How much do you have to spend on the improvements, and also the holding costs that you're going to have to carry, and things like that. So there are lots of different online calculators. Also, it depends on your exit strategy as well. If you're going to sell it, flip it, or if you're going to hold on to it. But due diligence, I think, is really important that you may want to consider doing. I gave you some ideas in today, but I've done some other live streams in past weeks where I talk about due diligence, because your first deal has to be a success. It doesn't have to be, it should be, because if it's a success, it's going to give you the confidence and the motivation to go to number 2, number 3, number 4, etc. If it's a disaster, then you're going to get so demoralized. You'll say, I'm done with this thing. I'm not doing more real estate. I'm going to, I don't know, start doing Amway or Amazon and so on. So yeah, it's really important that your first deal is a success. So if I can be of assistance to you on that journey, please let me know. If you want to book a one-on-one with me, again, I'm not selling it one-on-one, but we'll be able to deep dive, and I can provide you some cues, some things to look for, and maybe walk you through the process. So if you feel like I can, help you out, bring some value, provide a perspective, I'd be more than happy to do so. Just book a one-on-one with me. So go to my website and take it from there. It's called Ask Dr. Joe. Okay, we've got some good questions today. 750. Okay, sounds good. You're welcome. And Jennifer's in New Jersey. Hi there, in New Jersey. I lived in the condo 2 years out of 5. Oh, so you got no capital gains. Woohoo! So you're able to pocket that money. All right. So good for you, Melissa. And hopefully you can take that money, the gain, and then plow it into your property, your property in Cleveland, multifamily, and do something there. Katie, again, if you got some questions, please put them in the chat box. And I'll be more than happy to try to answer them for you. We're going to wrap it up in a couple of minutes, but if you got some questions, please put them in the chat box and I'll try and get to them. Hi, Dr. Joe. Thanks for tonight's info. Any tips on or directions on resources for funding a first-time investment, specifically in a multifamily property? Yeah, there are. It depends. If it's a 1 to 4 unit, then you may be able to get what we call residential financing. Now, if it's a 5+, then you're gonna have to get commercial financing, and there are lots of different commercial lenders out there. Depending on where you are, some you may want to consider commercial lenders. There's hard money lenders. There's private lenders who will fund multifamily acquisitions. So it depends on where the property is. Some of them have requirements and conditions that you may want to investigate. By all means, feel free to shoot me an email. I know a couple of lenders that I think again, it depends on where you are, that do multifamily, lending. And then you're going to have to work with them in terms of getting good rates and terms and conditions as well. So, so I'll be more than happy to, just shoot me an email, joe@joeasimo.com, and I'll be more than happy to send a couple of referrals to you. From within, I'll book a one-on-one. Thanks. Yeah, no problem. From within. Again, for everybody, there's really no need, I don't think, if you got questions that require a deep dive, and you think I can provide some context and advice and assistance, I'm not trying to sell this, but I've been doing this for 35 years, and I've made every single mistake you can think of, believe me. And so I don't see the necessity for you to make what I call unnecessary mistakes. Learn from my experiences, my mistakes, and my perspective, so that way you can get to where you need to go to a lot more efficiently. It's okay to learn from mistakes, but why learn from mistakes? Why make mistakes if you don't have to? You want to be surround yourself with seasoned people who are knowledgeable. It doesn't have to be me, but people who are experienced, people who are knowledgeable, people who want to help you without hidden agendas. And I don't have any hidden agendas. I do this with Wealth Wednesdays every week for free. I just enjoy it. I enjoy helping people. It gives me a lot of satisfaction to know that people are taking action. That's what I enjoy. So if you feel I can help you, then just book a one-on-one with me. I'm not trying to sell you anything. I just feel that if I had this service when I first started, I would have been financially independent a lot quicker than I did, because I didn't have a Dr. Joe to bounce ideas from to help me avoid silly mistakes I made. So again, I'm not trying to sell this thing. It's not my job. I just want to help. So if you feel I can be of assistance, feel free to book a one-on-one with me, and then we'll do a deep dive into your situation, whatever it is, and then we'll take it from there. Okay, Marathon Trucking. The price is $75K. It's already has a tenant in Section 8. It's 500 cash flow. Sorry, sir. Okay, so you've got a property. You didn't tell me the location, but it's $75K, which is sounds reasonable. Obviously, it's not in Washington D.C., but it's ready or already has a tenant, so it's occupied. And this tenant is a Section 8 voucher holder, and it sounds like they're getting $500 a month cash flow. I'm assuming that's after all the expenses are paid. That's not bad. If you're getting 500 cash flow on a $75K investment, that's not bad at all. Depends. Obviously, I would do some due diligence to make sure that the tenant is in fact paying. You want to make sure the tenant is in fact taking care of the property. You want to check the expenses associated with the property, and understand what the condition of the property is. If if there is some deferred maintenance, that will be your responsibility once you acquire it. So there's a few things that you may want to consider doing as part of the due diligence. But on face value, Marathon Trucking, it doesn't sound too bad what you got there. So yeah, no problem. From Within She Queens, my goal is buying whole. Well, congratulations. Buying whole is a good strategy if you know what you're doing. It's not a good strategy if you get tenants from hell. believe me. So the key is going to be, is managing, having an understanding of the process, understand how to find tenants, screen tenants, manage tenants. If it needs improvements, having good contractors or handyman who can help you. These are some of the things that come into play in order to be able to survive being a buy and hold, because there are so many different benefits. There's cash flow potentials, there's equity buildup, there's tax benefits, there's leverage. There's lots of things that you can do when you implement the buy and hold strategy. That's the reason why I do it, and so on. So okay, I think it's now 7:56. I'm going to wrap it up. Again, I've got an event next Saturday, June the 22nd, here in Washington, D.C. So if you are in the Washington, D.C. area, or if you are able to come down, I'll be honored to meet you. I'll be honored to sort of engage with you. And we're going to be meeting at one of my students' property here in Washington. Corliss and Fritz, they're a couple. This is their first property. It was a 3-bedroom, 1-bath. We're turning it to a 6-bedroom, 4-bath. And you'll see the good, the bad, the ugly. We're about midway through the renovations. The framing is done. The electrical, the HVAC, the plumbing is in. By the time we hit next Saturday, we should have completed what we call roughing inspection. And we'll probably put the insulation down, and we'll be ready to put the drywall up. So you'll see the house before the drywall goes up, and you'll kind of see behind the scenes, and we'll talk about the BRRRR. It's how to implement it successfully. We're not going to sugarcoat it. There's some good, there's some bad, there's ugly, and we're going to talk about all that. Also, there'll be a great opportunity to network with like-minded people. Okay, I think we're good. So DCC, recall you having a standing invitation to come to Houston. Hey DCC, how you doing? Long time no see. Yeah, so you're gonna buy me coffee when I go to Houston, huh? So okay, well, yeah, so maybe one day I'll go to Houston and I'll hit you for a Starbucks. How about that? And so on. So my friends, hopefully today was helpful. And I hope to see you next Saturday, June the 22nd, at the event here in Washington, D.C. You can sign up on my website, www.joeasimo.com, and look forward to seeing you. So with that said and done, I'm going to sign out at 7 o'clock, and I'll see you next Wednesday. Have a good one. Take care. Bye for now.